Manufacturing is coming back to the USA, and with it, some big opportunity. Back in July, I told you about 3 stocks and 1 ETF that were great opportunities at that point in time because they were riding the trend, and they've since skyrocketed by over 40%. Now, in part 2, I'm going to be revealing 3 more stocks. The first one, Honeywell, symbol HON. The next is ROK, Rockwell Automation, and lastly, a transport, CSX. And while their businesses are boring, stodgy, there's certainly no NVIDIAs. These folks are primed to benefit from America's manufacturing revival. If you missed out the last time, don't make the same mistake twice. Tune in here to catch these early movers. And I will be posting at the end of this video part 1 of my analysis on the reindustrialization and onshoring of manufacturing coming back to the United States. So what I want to talk about today is the trend. Is the trend that I identified back in 2023, is it still sound? We've had a trend that began back in the Trump administration where we saw a parabolic rise in the onshoring of manufacturing back to the United States. The question is, did it continue under the Biden administration? And with an upcoming election, will the policies of a new Trump administration or a Harris administration, will they impact positively or negatively this trend? We're going to talk about the whys behind this trend. We're going to talk about the trend itself. How does it look? And then we're going to do a deeper dive. We're going to go into the symbols that I mentioned, Honeywell, CSX, and Rockwell Automation. We're going to talk a bit about their fundamentals, and then we're going to leave it off with my specialty, which is technical analysis. And on each, we're going to spend a little bit of time talking about a strategy in which to deploy if you're considering accumulating a position in either or all of these names. So let's get to it. So what you're looking at here is a graph going back to 2002 of the onshoring of manufacturing back to the United States. And by and large, this is a very, very healthy trend. And in fact, beginning back in 2017, with the passage of the tax cut bill under the Trump administration, you saw a parabolic rise in the onshoring of manufacturing, and that was pre-COVID. President Trump made it clear that this is one of his primary goals as president, to bring back jobs, to bring back industry back to the United States for various reasons. Primarily to broaden out the middle class, because don't forget, the U.S. economy is based upon a healthy consumer. Without that consumer, the United States will have a very, very difficult time maintaining a healthy GDP. Now, with all the vitriol between the politicians in Washington, D.C., and the hatred of one another, whether it be Biden versus Trump, Trump versus Biden, Biden versus Harris at this point, Harris versus Trump, whatever, one would think that there would be a derailing of this policy in some form or fashion simply because they didn't like the guy, meaning Trump, under his administration. They were going to derail his policies. In some instances, that was the case. But let's be honest, that is not the case here. The Biden administration took office here in 2020, and clearly the path of least resistance for the onshoring of jobs back to the United States, the path of least resistance is clearly to the upside, to the point of calling this almost a parabolic move. Now, why did that happen? Well, I mentioned earlier that the primary goal under President Trump was to broaden the middle class, to bring back what was a thriving middle class. But then we had COVID in 2020, and President Biden passed 2 pieces of legislation. One was the CHIPS Act. The other was the Inflation Reduction Act. Now, while these 2 bills were highly accretive to our national debt, they did have their good component. There were incentives to bring back semiconductor manufacturing, as well as providing incentives to alternative energies and the EVs and EV batteries as well. Now, I briefly touched upon COVID, and it would be an understatement for me to say that one of the primary reasons as to why the onshoring of U.S. industrial manufacturing has gone parabolic is simply because of the supply chain disruption that we saw during COVID and the subsequent spike in inflation once the government began printing money and people were chasing too few goods with money that was printed out of there. So much of the rising onshoring activity was caused by tariffs that was under the Trump administration and continued under the Biden administration on Chinese imports and the Tax Reform Act of 2017. Made in China products, for example, currently have a 25% tariff on approximately 250 billion of imports across a broad swath of categories. The Tax Reform Act, meanwhile, lowered U.S. manufacturers' tax rate to 21%, significantly less than worldwide average manufacturers' tax rate, 24%. Now let's pause here and remind folks, whenever you wonder why a trend is happening, we always go first to the question, who profits? Where is the money flowing? And clearly at current, this snapshot in time, October the 19th, 2024, the Dow Jones this past Friday hit all-time record highs in addition to the S&P 500. What did not make new all-time record highs? The triple Qs. So it's the industrial stocks that are driving this stock market up higher. As a result of onshoring in 2022, 360,000 manufacturing jobs returned to the United States, a 53% increase from 2021. 2023, forecasts project 400,000 manufacturing jobs returning to the U.S., 51% coming from China. This will bring a total number of reshored jobs to 2 million since 2010. Now, this is where it gets interesting for us. Spending on construction related to manufacturing rose 76% in May 2023. Remember, it was July of 2023. I made part one of this reindustrialization and onshoring back to the United States video series. Back to the bullet point. Again, in May 2023 compared to last year, increasing a seasonally adjusted annual rate of $194 billion. In addition to the U.S., Mexico also stands to benefit from greater onshoring, experiencing foreign direct investment of $12 billion in 2022 while adding 170,000 manufacturing jobs in Q1 2023. I'm optimistic here. I'm so optimistic because I went and I did a little bit more research on FDI, as mentioned here, foreign direct investment into Mexico. Now, this graph here illustrates foreign direct investment into yellow, the European Union. India actually saw a loss. Remember, this is only from 1990 to 2023. So it's a bit dated, not much, but a bit dated. So for 2022 and 2023, they saw a loss. China clearly saw a loss. The United States saw a dip as well, but by and large, the United States in green has seen far more foreign direct investment over the past several years than our competitors. Now, there are other factors that are driving the reshoring of manufacturing back to the United States, not just COVID, not just tax changes, but the United States is now the largest energy producer in the world. According to Colliers, several factors have caused companies to reconsider the U.S. for their manufacturing expansion or relocation. A significant one is energy. Low-cost shale gas has transformed energy competition to provide the U.S. an advantage, especially for heavy users of automation. What's more, the United States government has used tariffs to improve the competitive posture of domestic producers. Now, this chart here further illustrates the massive parabolic spike in reshoring back to the United States post-COVID. And the final chart before we get into the stocks that I like moving forward to take advantage of this now very well-established trend. Take a look at total manufacturing here in the United States. We saw a dramatic rise even beyond the highs of 2018 post-COVID. And while we've stalled out a bit since 2022, you could blame that on an increased rate regime. Yet now that we've turned the corner on that, it appears as though we're going to get our second tranche of rate cuts and perhaps a new administration, which is going to be far more business friendly. We could easily see a breakout here to the upside in manufacturing here in the United States. And whoever wins, Mark Twain had a saying, if voting made any difference, they wouldn't let us do it. Think about it. So It doesn't matter if it's a Harris administration. It doesn't matter if it's a Trump administration. I think the only difference is going to be the rate of change to this already established trend, which I think in either case, whoever's elected is going to be up. Now, as I previously mentioned back in July of 2023, I did part one of this video series and I had 3 stocks which I really thought were going to do very, very well if my hypothesis about the reindustrialization and onshoring of manufacturing back to the United States continued to play out. The first one was Avalon Bay. And since I did my analysis, though, that share price has risen by 31%, and that does not include a nearly 3% dividend. And you may be asking, why? Why rental community? Well, people need to live somewhere, and Avalon Bay is a very high-end or upper middle class to high-end community. So these companies, these manufacturers are going to need to hire managers, and they're going to have to pay them accordingly. So Avalon Bay, one of the beneficiaries of reshoring back to the United States. Add to that the fact that there's demand and there's pricing power. So do I think there's still more upside here to be had on Avalon Bay? It looks that way, but it's a little bit extended. And I want to focus more on the sleeper stocks, those names that haven't really run yet. So I still think that Avalon Bay is a buy on a pullback. And if I were long, I would remain long. You still have rising fundamentals or revenue growth. And before I leave this chart, you can still see that we have rising revenue growth. Oh, let me pause here. Many times I'm asked, what charting software am I using? Folks, we are using TrendSpider. They are a partner and sponsor of ours. I usually mention them. Sometimes I do not. This charting software for those folks that are both experienced and inexperienced, and they're looking for automation applied to their technical analysis. What does that mean? Well, hypothetically, you're an inexperienced trader and you're trying to familiarize yourself with drawing support and resistance levels. Wouldn't it be nice to have an online real-time tutorial to help validate or invalidate the accuracy of your support and resistance levels? Or if you're an experienced trader like me, wouldn't it be nice to leverage the multi-time frame analysis to help identify where there might be support and resistance levels, and to also validate the accuracy of your own charts? If you're confused with what I'm talking about here, let's do a quick run through. So I purposely, for illustrative purposes, taken off the moving averages and the overlays to keep this nice and clear. So using the power of TrendSpider, we want to identify whether or not is it a good opportunity right now to open a position here, or is it time to perhaps to book some profits? Now, on the daily chart, I'm simply going to click this button, and the algorithm is going to populate support and resistance levels with a click of a button. And there you go. So you can see back here in September, on September the 16th, we hit these series of resistance levels immediately above, and these support and resistance levels are generated by the algorithm using historical price action. And if you're at all-time highs, it extrapolates out prior highs to where there might be, in all probability, resistance above. So in this instance, we know we have overhead supply up at around 235.90. Now let's take a quick peek at a weekly chart. Now, using an overlay of weekly support and resistance on a daily chart, this makes this chart all the more powerful, because in dashed line is now weekly support and resistance, and in solid line is the daily resistance levels and the support levels you saw earlier. So the algorithm is picking off good, strong support at around 221 per share. So we have support, weekly time frame, 221 per share. Resistance now initially at this prior peak here, 235.81, but ultimately at around 239, because again, the algorithm is extrapolating out probable resistance levels above, making the assumption that we will clear this hurdle right here. But as an experienced trader, we can draw our manual resistance level, and we can appreciate the fact that we know that in all probability, there are going to be sellers at that resistance level, and I could easily create an alert to let me know where I long, AVB, weekly resist, if I was so inclined to lighten up on my position at that resistance level, and my alert is set. There it is. Now let's pull back and take a look at a weekly chart. And on top of that weekly chart, we now have monthly resistance on top. And you can see that, as was the case on the daily chart, we had resistance at around 234, 235 per share. And we're going to have resistance at an even lower price target than what I mentioned earlier at around 236 per share. Now I'm going to take this resistance level and I'm going to apply it to all time frames. So that way I see it not just on the daily chart, but on the weekly, monthly, quarterly, wherever it may add value. Now here's the weekly chart. And there you have resistance, as I had manually drawn, actually coincides with monthly resistance, but I'm experienced. A lot of people out there are not. You may not be as experienced. So this just validated the accuracy of my daily resistance level. And if you're new and you don't have that experience, well then, the algorithm just did the work for you. So folks, the analogy I use is that if you are a trader, it's akin to being an archer, and an archer needs arrows. And if you don't have TrendSpider, well then you don't have arrows in your quiver, because I could assure you right now, as sure as God made green little apples, your competitors out there, your fellow traders are using this software. We are in the automation age. So use that link below if you watch this on YouTube or on Twitter above. And if you watch this on the website below as well, you'll get a minimum of a 35% discount using my discount code CON35. And I believe in it so much that I give it away free to our silver and gold level members. So take advantage of it. Now, the second stock, which I suggested back in July of 2023, was ESS, Essex Property Trust, and that rose 51%. And in addition to the net asset appreciation of the share price, it also would have paid you a 3.3% dividend yield. Now, the other product that I had suggested be looked at as a potential trade was MLPX. This is an ETF on energy. MLPX, the symbol, and since that point in time, it is up 56% on a dividend yield of 4.25%. So talk about a home run here. The next ETF that I had recommended, and I believe I said one ETF earlier, it was actually two, MLPX and VPU. VPU is a utility ETF, which just makes sense. If you're going to be reshoring manufacturing, you need energy. You need utilities. And VPU, since that point in time, is up 32% on a dividend yield of 2.5%. And the last symbol I had recommended back in 2023 was WCN, Waste Connections Incorporated. That is up 44% on a dividend yield of 0.60%. Now, looking at this chart here, it looks as though there's more room to run to the upside. Looks like we're flagging out or doing a bull flag setup, and the path of least resistance remains to the upside here on WCN. Let's overlay some support and resistance levels out of curiosity. Yeah, so you could see back in August, we hit this upper band of the rising uptrend channel. We have since pulled back. We're putting in, let's get this out of the way, we're putting in higher lows, which is exactly what you want to see. And it appears as though we're getting ready to take out prior highs. Now, the problem for this stock is that you're now entering the apex of an ascending wedge formation. For me, there's too much risk and not enough reward to enter this trade, which brings me to strategy with regard to the trades that we are looking to put on to take advantage of this continuation move up higher in the reindustrialization, reshoring of manufacturing back to the United States. Now, this is a monthly chart of the Dow Jones Industrial Average. You can see that we are at all-time record highs. This is a very powerful chart. And frankly, it looks as though the path of least resistance remains to the upside. Here's your upper band of resistance here. Let's overlay quarterly resistance to see whether or not we have any speed bumps ahead of us. And here it is. It's highlighted. And no, the path of least resistance remains to the upside. Let's take our drawing tool out and see whether or not we can manually identify any problems with the Dow Jones Industrial Average. Judging by this lower band of support, we appear very healthy. We pull back, we tap it, we move up. Taking a look at the rising upper band of resistance, what did we do last week? Actually, I should say the week prior, we broke out. Last week, we did a pullback and a retest. It looks as though the path of least resistance remains to the upside. But context matters. What is the context? The context is that while the path of least resistance for the S&P 500 and the Dow Jones Industrial Average remains to the upside, the valuations of the overall market are very, very frothy as measured by the Shiller PE ratio. We're just shy of the October 2021 highs, which was about 38 on the Shiller PE multiple. We closed out the session on Friday at 37.35. We are in the midst of earnings season. The week ahead is chock full of big companies reporting. We'll be talking about earnings on Sunday Night Futures Live, 6 p.m. Eastern Standard Time every Sunday and Thursday. Please join us. Is this graph here a reason to go selling your stocks? The answer is absolutely not. What matters most is the price action. The however is that if you're looking to initiate new trades, you need to take into consideration the condition, the health, and the frothiness of the overall market in terms of advanced technicals and the valuation of the market. So now that we've put some context around the stock market during this snapshot in time, we are now in a good position to say, okay, what is our strategy for entering trades in Honeywell, Rockwell Automation, and CSX? So the first chart we're looking to analyze to take advantage of the reshoring trend is CSX. It is in the transportation and rail group. It has a composite rating by Investors Business Daily of 48. Not impressive. This is a boring, stodgy company. The however is, it's a steady Eddie. And through my analysis, it is one of the best positioned to take advantage of the reshoring of manufacturing. Now, what you're looking at here is the IBD ratings for CSX. Earnings per share, 79. Not great. It's not a leader in the transportation space. Relative strength right now, nobody wants it. That's why we're looking at it. Relative strength relative to the S&P 500 is garbage. The group strength, D, it's out of favor, meaning the rails. The transportation sector is breaking out. At some point in time in the near future, these names are going to catch fire because the transports are breaking out. And what nobody wants you to pay attention to is this little green dot here. Accumulation distribution. The shares are now under stealth accumulation. And when we take a look at as we take a look at the data for CSX, we have EPS date of the 16th of January. Last quarter EPS growth was 12% with an annual ROE. That's return on equity. That shows the efficiency of management. A ROE in the teens is considered to be very respectable. The ROE on CSX is 29.7, and it's paying a dividend of 1.4. Now, there are other railroads out there with comparable fundamentals, but in terms of market positioning and dividend yield, CSX floated to the top because this is a stock that isn't necessarily going to go ripping through the ceiling on Monday morning. So you'll value the fact that you're being paid a dividend while you wait. Now, let's talk about the chart of CSX. Now, this is a chart that I had been actually watching for the past several weeks due to the fact that it was appearing on my screener as having a Bollinger Band squeeze. What is that? That is when you have the Bollinger Bands in red trading within the Keltner channels. And we saw that back in August. So I began to track it, and this is on a daily time frame. Now, what I like so much about this chart right here, right now, is not the most recent price action. The recent price action was quite abysmal due to the fact that they reported earnings. And frankly, the earnings were a mix of both demand related for their business and a reflection of the overall economy and the weakness in the consumer, but also they had some non-recurring issues related to inventory. What inventory they would have, not quite sure. So it could be the inventory by their customers, not so much their own internal inventory. Now, the upshot here is that we have rate cuts which have begun. We're looking at more at the beginning of November, and that should help stimulate growth. Now, looking at this chart here, would you be shocked if I told you that CSX is actually in a bull market? If you said I was nuts, I wouldn't argue with you. But what we do here at the Contrarian Trader is that we don't just look at one snapshot in time. We're not going to analyze a stock that we may be in for several months to several years simply based upon a daily chart. We need to have a hypothesis. That hypothesis is that we will have the onshoring of manufacturing back to the United States continue. As it relates to technicals, we're not going to use a daily chart. We're going to use a weekly chart and a monthly chart. So I mentioned earlier, we were in a bull market. So allow me to validate that statement. So we bottomed out here in October of 2022. Here is your rising lower band of support. We're just off of that support level. And we broke out back here in November of 2023, only 4 months after I made my last video about the reshoring of manufacturing, and the shares took off after this breakout, retest 1, retest 2, follow through to the upside. Now we've gone into correction mode, and they had that poor earnings report because just prior to that earnings report, these shares were getting ready to take off. Now we remain inside of a triangle formation, and take note of the Bollinger Band squeeze that's setting up on a weekly time frame. It could be a major breakout, or it could be a major breakdown. So how do we stack the odds in our favor? Well, what we do is we take a look at the moving averages. Right now we have the 20-period moving average in green. We're trading above it. We've been trading above it since before earnings were released. So what we want to see are shorter term moving averages, such as the 5-period moving average in yellow stacked above the longer duration moving averages. We have that. So what's the strategy here? I think the strategy here with CSX is that we begin to dollar cost average. Nibble until such time as we get the breakout above this upper band of resistance here at around, let's call it $34.50 per share. We closed out the session on Friday at $34.12 per share. We're not that far away. Now, if we pull back and retest this lower band of support at around $33 per share, there's another area where we begin to nibble on the shares. But we do not want to get aggressive until we start breaking out above resistance levels. Where might those resistance levels be? I'm glad you asked. Let's just click a button. Automated trend lines. And there you have it. Resistance is up at around $36 per share. So we need to get these shares as close to this lower band of support as possible, or immediately after a breakout and a retest of this current resistance level, or a mixture of both. And for a broader perspective, let's take a look at a monthly chart to reinforce the fact that we are in a bull market on CSX. So don't allow these daily charts to influence you too much. If you're a trader and you're looking for a short-term swing trade, this is not for you. If you're looking out a few months to several years, this is a trade for you. But you must dollar cost in. Now, the next chart that I really like a lot is Honeywell, symbol HON. At current, it has a composite rating of 75 by Investors Business Daily, which is not very sexy. The however is that these are cyclical names that we're talking about. The Dow Transports, CSX, Dow 30 names like Honeywell, and power and equipment names like Rockwell Automation. Now, as was the case with CSX, Honeywell is not in a loved group. It has relative strength rating of C-, so it's lagging the S&P 500. Accumulation distribution, though, is an A. These shares are under stealth accumulation. And it's our job, using the charts, to identify when is the best risk-reward entry point to take advantage of this trade. Now, in terms of fundamentals, I mentioned this earlier with regard to CSX, return on equity, 39%. This is strong management. It's reporting earnings on the 25th of October, next week, and it has a dividend yield of 2%. Let's go to the chart. Now, you can look at this daily chart and you could say, wow, you know, it looks like the horse has left the stable here. I don't want to touch this one. And I don't necessarily blame you, especially since we have earnings coming out this coming week. And that's what you call a binary event. It's an event that you don't know what's going to happen. The stock could surge or it could drop like a rock. We don't know yet. Therefore, we will not be opening a position in advance of earnings. So to use a daily chart to do analysis on a stock that we're looking to hold for months to years is just plain silly. What we want to do is we want to go to a monthly chart first. We want to take a look at a chart that allows us to identify where the stock has been to appreciate where it may be going. Now, this stock petered out back here in August of 2021. It pulled back, found a floor, and what is it doing now? Well, here you have a higher low, a series of higher lows. So a very strong consolidation, and this consolidation resulted in the Bollinger Bands tightening up inside the Keltner channels, and it appears as though we are getting to have liftoff on Honeywell. So while it looks very extended on a daily chart, the monthly chart is telling you this stock looks like it's getting ready to rip up higher. And in fact, so far on the month, we have broken out. Let's overlay the automated trend lines. Click of a button. And there you have it in green. You could see, let me get rid of my annotation. In green, it's identified the breakout point. And this stock has a whole lot of room to run up to about 260 per share. So Honeywell looking very, very bullish, and nobody's talking about it, at least publicly on CNBC, because they do not want you to know that these shares of this stodgy company that is not sexy are under institutional accumulation. Now moving on to Rockwell Automation, symbol ROK. This one really has a poor composite rating of 51. So clearly, the technicals here are not lovely. The stock is not in play in any form or fashion in terms of fundamentals. But that's not what we do here. I outsource my fundamental work to Investors Business Daily. What we do here is we read the tea leaves. So when I take a look at the fact that the composite rating is only 51, EPS is only 55, hardly what I would call sexy, along with the relative strength versus the S&P 500 of only 25. Then I go on to see accumulation distribution and the group strength rising in green. Well then, that has my interest. That tells me there's something going on here. Now, as with the other two names, stodgy old names, not sexy, what do they have? Strong management, strong return on equity. As I mentioned earlier, any read of ROE that's in the teens is considered respectable. This company's return on equity is 44.8. It's got a dividend yield of 1.8%, and it has a beta, which is a measure of volatility, of 1.32. To put that into context, if a stock has a beta of 1, it's considered above 1. Obviously, it gets more and more volatile. So what this tells us is that this stock has the potential to give us a rip-your-face-off rally. But is that potential reflected on TrendSpider? Let's check it out. So here's this daily view of Rockwell Automation. It's all right. It's lethargic, moves up higher, pulls back. It's moving up higher at current. Nothing really to garner our attention, but this is not what we do. This is not a short-term swing trade. There is no momentum here. The only momentum is sideways. What we want to do is we want to do what we did earlier. Show us where the stock has been to identify where it may be going. This is the monthly chart. Now you can see they had a great run up and into January of 2022 and then went into correction. We rallied up and into July of 2023. That's when I did my video. And we are down below that point at current. What do I think is happening here on the monthly chart? I think that we're consolidating for a major breakout. Now I'm going to overlay a heat map on top of this chart, monthly chart, and it's showing you that you have a bit of resistance immediately above. Nothing major. Let's take that off. Let's take a look at the candlesticks, and you can see that we have lots of bottoming action. If you want to call them shadow, wicks, whatever you want to call them, it doesn't matter to me. Call them cupcakes. This implies that we have support below. Now, what are we looking for in this monthly chart? Let's take our crayon out. We're looking for this. We're looking for a breakout. And take note of the fact you have the Bollinger Bands in red now flirting with establishing a base inside the Keltner channels. Much as it did back here, took a few months for that to happen, for these Bollingers to get very, very tight. But when this fired off, it fired off huge to the upside. Now, taking a look at the weekly chart, I'm going to overlay some resistance levels and support levels. And you can see that we flirted with a breakout on the week last week, but it was rejected. Now, I'm going to take these off because I want to illustrate something that's very attractive to me. Take note of the Bollinger Bands in red inside the Keltner channels. Look at how tight these Bollinger Bands are. Very similar to the monthly setup. Let's go back to the monthly chart back here. So we have earnings coming up on, I believe it's the 30th of October. So which way will this fire off? Meaning the Bollinger Band squeeze to the upside or to the downside? We don't know. The however is, or the probability is that it's probably going to fire off to the upside. Why? Because that's the trend. We're putting in higher lows. We have a long consolidation, and we have stacked moving averages with the shorter duration moving averages trading above the longer duration moving averages. Now, these observations provide no guarantee that we're going to fire off to the upside, meaning this Bollinger Band squeeze, but it certainly puts the probabilities on our side. So folks, when I do begin to enter these trades, I will be sending out alerts to our members. If you're not currently a member, please sign up for your 14-day free trial offer to the Contrarian Trader. If you sign up for the silver and gold level member, if you were impressed by TrendSpider, guess what? You get it for free. Use the link below to sign up. Again, 14 days free. If you're not ready yet, that's fine. At least join us on our live streams, Sunday nights and Thursday nights, as well as join us in our trading community. You can find links to those below. I'm also going to provide you links to these charts below as well. And of course, don't forget, sign up for TrendSpider, 35% discount code below. CON35 is your discount code. Everybody have a profitable trading week. Members, I already posted the week ahead commentary. Go check that out. It's posted in the members area. I hope to chat with everyone on Sunday evening on Sunday Night Futures Live. Till then, have an awesome weekend. Be well.